The $1 billion our exit strategy. Welcome back to my channel World Market Insights. Today is January 24th, 2026. I was looking at the silver price after close last night and it touched 13.7 per ounce. Let that sink in for a moment. $13 for a single ounce of silver. And yet, the real story isn't even the price. The real story I have for you today is what one man did in early 2025 when almost nobody was paying attention. His name is David Bateman, tech founder, serial entrepreneur, and in the span of roughly 5 months, he converted nearly $1 billion of wealth into physical silver and gold. Not paper, not ETFs, not futures contracts, physical metal, 12.69 million ounces of silver. That's 1.5% of the entire planet's annual supply. But the most insane part of the story isn't what he did, it's why he did it. He didn't do this because he thought silver was undervalued. He did it because he saw the $300 trillion global credit bubble for exactly what it is, a mathematical certainty of collapse. And when that bubble pops, Bateman understood something that 99% of investors still don't. The only wealth that will survive is wealth that doesn't require anyone's permission to exist. But here's what should keep you up at night. The most terrifying part of this story isn't the bubble popping, it's what happens to everyone holding paper when the vault doors finally lock. And those doors are already starting to close. Let me be very clear about what we're dealing with here. We are in the final stages of a global monetary system that has been held together with duct tape, propaganda, and the collective delusion that numbers on a screen equal real wealth. David Bateman's move wasn't a trade. It wasn't him trying to time a swing or catch a momentum wave. It was an exit. Between October 2024 and March 2025, Bateman systematically converted close to 1 billion into 12.69 million ounces of physical silver and substantial gold holdings. But here's where it gets interesting. At the same time, he was buying physical metal. He was liquidating his position in SLV, the largest silver ETF on the planet, 11.3 million shares gone. Why would someone dump paper while simultaneously buying physical silver? Because Bateman understood that SLV isn't a store of value. It's a tool for price manipulation. It's a promise from a financial institution that you can redeem your shares for silver. But that promise is only as good as the institution making it. And in a crisis, those promises evaporate faster than morning dew in the Mojave. My goal in the next few minutes is to break down the exact mechanism that Bateman understood, something called zero counterparty risk. I'm going to run the math on why silver specifically is the stratospheric play that most analysts still refuse to acknowledge, and I'm going to share the exact triggers I'm watching in my personal positioning right now. Because here's the thing, before you can understand why a $1 billion move makes sense, you have to understand the trap that 99% of investors are currently walking into, and that trap has a name. Let's pull this apart. When most people think about wealth, they think about the number in their bank account, their stock portfolio, maybe some crypto holdings. But here's the uncomfortable truth that nobody wants to say out loud. Almost every modern asset is not actually an asset. It's a promise. Your bank deposit, that's a promise from the bank to give you cash when you ask for it. Your stocks, those are promises from companies to honor your ownership stake. Your crypto, in most cases, that's a promise from an exchange or protocol to recognize your claim. Even paper gold and silver on the ETFs, the futures contracts, the allocated accounts, those are promises from institutions to deliver metal if you ever decide to take delivery. This is what we call counterparty risk. Your wealth is dependent on another party fulfilling their obligation. Now, in normal times, this system works fine. The promises get kept, the gears turn smoothly, but we are not in normal times. We are sitting on top of a $300 trillion credit bubble where the counterparties themselves, the banks, the governments, the institutions making all these promises are facing insolvency. Zero counterparty risk means the asset's value is intrinsic and completely independent of any institution's solvency. Let me give you an analogy that makes this crystal clear. Imagine you're starving. You have two options in front of you. Option 1, a high-resolution photo of a sandwich on your phone. Beautiful image. You can zoom in and see every detail. Option 2, an actual sandwich in your hand. Which one are you going to eat? Paper silver, ETFs, digital ledger entries. Those are the photo. Physical silver sitting in your possession. That's the actual sandwich. And when the hunger of a financial crisis sets in, you cannot eat a photograph. Bateman saw this. He understood that in a collapsing system, the only wealth that matters is wealth that exists independent of the system's survival. With silver currently trading at 13.7, the market is no longer pricing in economic growth. It's pricing in settlement certainty. It's pricing in the growing realization that when the music stops, there won't be enough chairs. But Bateman didn't just understand the counterparty trap. He found a secondary trigger that makes silver uniquely positioned, something the banking cartel has been desperately trying to suppress. Industrial mathematics, the metal nobody can ignore. Here's what the precious metals market looked like when I checked earlier this morning. Silver 13.7 bid, 10,369, ask up 6.34%. Gold $4,982.49, holding the line just under 5,000. Platinum $2,682.5, up 3.23%. Now to the average investor, these look like big numbers. Metals are expensive. I missed the boat. But that analysis completely misses what's actually happening. For decades, the price of silver has been artificially suppressed by what Bateman and other analysts call the bullion bank cartel. Major institutions that use paper derivatives to create synthetic supply and keep physical prices lower than they should be. The mechanism is simple. You flood the futures market with sell orders for silver you don't actually have. The price drops, retail investors panic and sell. You cover your shorts at a profit and do it again next month. It's a beautiful racket if you're a bank with infinite paper, but it only works as long as people are willing to accept paper as a substitute for physical, and that's where the drainage begins. By late March 2025, Bateman was already up 20% on his physical purchases, not because he timed some technical breakout, but because he moved early before the tariffs hit, before the supply shortages became obvious, before retail demand turned into a tsunami. He understood that the window to acquire physical metal at suppressed prices was closing. Now here's the thing about silver that makes it absolutely unique. Silver is a 25 billion industry. Gold is 300 billion. What happens when just a tiny fraction of capital shifts from gold into silver? The price doesn't just rise, it slingshots. Bateman called this effect stratospheric, and the math backs him up completely. But if this is so obvious, if the setup is this clear, why are the smartest guys in the room still telling you to sell? Every time a contrarian thesis gains traction, the establishment analysts come out with their rebuttals. Now let me address the two biggest objections I hear about silver. Skeptic argument. Number 1, substitution. The claim is simple. At $100 per ounce, industries like solar panel manufacturing and electric vehicle production will substitute silver for cheaper alternatives like copper. Demand collapses. Price follows. Sounds logical, right? Here's the problem. It's based on a complete misunderstanding of why silver is used in high-tech applications. Take solid-state batteries, the next generation of EV technology. A Samsung solid-state battery requires 1 kilogram of silver, not because silver is cheap, but because the electrical conductivity and thermal properties of silver are irreplaceable for that level of performance. Bateman's research on this is airtight. The tech performance gain is so superior that the industry can tolerate a 5 times price increase before engineers even start seriously considering substitutes. You're not swapping out silver for copper when the entire value proposition of your product depends on silver's unique physical properties. This isn't like substituting plastic for metal in a car door panel. This is fundamental materials science, and here's what the substitution skeptics completely ignore. The innovation pipeline is moving toward more silver usage, not less. Photovoltaic cell efficiency improvements actually require higher silver content per panel, not lower. The newest solar tech uses silver nanowires and advanced metallization that increases silver loading by 15 to 20% compared to older designs. So even as panel efficiency goes up, silver demand per watt of capacity is climbing. The International Energy Agency projected that solar installations would need to triple by 2030 to meet climate targets. That's not a demand cliff, that's a demand explosion, and it's already baked into the supply-demand equation that Bateman was calculating when he made his move. Skeptic argument number 2, recessionary drag. This one goes like this. A global economic collapse destroys industrial demand for silver. Factories shut down. Solar installations stop. Car production grinds to a halt. With industrial demand cratering, Silver's price should collapse alongside the economy. Again, sounds reasonable on paper, but it ignores the entire other half of the silver demand equation, monetary demand. When fiat currencies fail, when the dollar, the euro, the yen start losing credibility, people don't stop wanting a store of value. They don't just shrug and accept poverty, they flee into hard assets. And in a currency crisis, the monetary demand for silver as a life raft vastly outweighs any loss of industrial demand. Look at history. Look at Weimar Germany. Look at Zimbabwe. Look at Venezuela. When the paper burns, people scramble for anything real. Now, here's one I actually find amusing. There's this persistent myth that gold is better for escaping because it's more portable. Pack your wealth, cross a border, start over. True enough, if you're carrying $10,000 worth, but Bateman made an interesting point that most people miss. For large-scale wealth protection, silver's weight is actually a feature, not a bug. It's harder to steal. Think about it. If you're trying to protect $1 million in metal, that's about 200 lb of gold or $20,000 lb of silver. Which one can a thief walk out with? Which one requires a forklift and a truck? I'm not saying silver is better for every use case. I'm saying the silver's too heavy argument is lazy thinking. The skeptics are staring at spreadsheets, running regressions, building models based on the last 30 years of market behavior. Bateman was looking at the physical supply of the Earth itself, and that math is absolutely terrifying. The numbers don't lie. Let's talk about the 1.5% rule. Bateman's purchase of 12.69 million ounces represented roughly 1.5% of annual global silver supply. One person, 1.5% of planetary supply. Now think about what happens if just 1.5% of the capital currently sitting in the $300 billion gold investment market decides to rotate into silver. Not 10%, not even 5%, just 1.5%. The silver market is $25 billion. Gold is $300 billion. If 1.5% of gold investment capital, $4.5 billion flows into silver, you're talking about an 18% increase in total silver market capitalization. But it doesn't work like that in reality because silver supply is inelastic in the short term. You can't just mine more silver tomorrow because price goes up today. Mine development takes years. So when demand surges, price doesn't climb gradually. It gaps up violently as buyers chase a shrinking pool of available metal. This is what Bateman meant by stratospheric. And here's where the mathematics become truly uncomfortable for anyone paying attention. The global silver market operates on approximately 830 million ounces of annual mine production. That's the entire planet's output. But annual industrial demand alone sits around 600 million ounces. Solar panels, electronics, medical equipment, water, purification. These aren't optional uses that disappear when price rises. These are critical applications where silver's unique properties make it irreplaceable at almost any cost. So, we're already looking at a structural deficit before we even consider investment demand. Now add in the fact that roughly 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Silver isn't the primary target, it's what you get while digging for something else. What happens when copper prices fall or those base metal mines become unprofitable? Silver production drops, but not because silver demand decreased. It drops because the economics of the primary metal no longer justify operating the mine. This is a supply constraint that has nothing to do with silver's price and everything to do with the price of completely different commodities. Bateman understood this dependency. He knew that silver supply can't respond to price signals the way a pure silver mine could. The supply curve is broken, and that creates a powder keg. I was reviewing the World Silver Survey data from 2024, and here's what jumped out at me. Identified silver reserves globally are estimated at around 570,000 metric tons. Sounds like a lot, right? That's roughly 18 billion ounces. But at current consumption rates, including both industrial and investment demand, that represents less than 22 years of supply. 22 years until we've exhausted every known economically viable silver deposit on Earth. And that's assuming no increase in demand, no acceleration in solar adoption, no surge in electric vehicle production, no monetary crisis driving investment demand through the roof, just baseline business as usual consumption. Now, will we discover new deposits? Probably. Will recycling rates improve? Maybe. But here's the reality. Silver recycling is already happening at close to maximum efficiency for industrial applications. You can't recycle silver that's been dispersed into the environment through medical uses, or that's sitting in landfills and trace amounts in old electronics. The economics don't work. And new mine discoveries. The last major primary silver discovery was over a decade ago. We're not finding new deposits at anywhere near the rate we're consuming existing ones. So when Bateman deployed $1 billion into physical silver, he wasn't just betting on short-term price momentum. He was betting on geological reality. He was betting that 12.69 million ounces of physical metal locked away under his control would become increasingly difficult for anyone else to acquire as the mathematical reality of supply constraints became undeniable. This isn't speculation. This is arithmetic. Annual supply 830 million ounces. Annual demand pushing toward 900 million ounces. Known reserves 22 years at current rates. The equation doesn't balance. And when an equation doesn't, retail demand becomes a tsunami. The last thing the establishment wants is more publicity driving even more demand. But there's a bigger risk on the horizon that most investors aren't even thinking about: nationalization. Mexico is the world's largest silver producer. And over the last year, there have been increasing signs that the Mexican government is moving toward mine nationalization, taking control of silver production from private companies. If Mexico officially nationalizes its silver mines, global supply lines get severed instantly. You can't just replace Mexican silver production overnight. We're talking about a massive chunk of global supply suddenly under government control, and governments in crisis don't export their strategic resources, they hoard them. And here's something that keeps me up at night. Peru and Bolivia are watching Mexico closely. These countries hold the second and third largest silver reserves on the planet. If Mexico nationalizes and succeeds in keeping that wealth domestic, you'll see a domino effect across Latin America within 18 months. Political movements in both countries are already calling for resource sovereignty. It's not a question of if, it's a question of when. And when that happens, the remaining free market silver supply will be concentrated in countries like Australia, Canada, and the United States. Nations that could easily impose export restrictions under the guise of national security the moment strategic metal supplies become politically sensitive. We've already seen this playbook with rare earth elements. China restricted exports, and the West scrambled for alternatives that took a decade to develop. But you can't create new silver deposits. They either exist or they don't. The highest grade deposits are already being mined. So here's what I'm watching like a hawk. First, the silver to gold ratio. If we approach 40 to 1, silver is becoming overheated relative to gold. That doesn't mean sell. It means the first wave of the move is getting exhausted and we might see a consolidation. Second, the VAT and tariff spigot. In Europe, there's already a 20% VAT tax on silver in many countries. If that spreads, or if new Trump-era tariffs make physical acquisition prohibitively expensive for the average person, the ability to buy metal disappears regardless of price. Watch for regulatory changes that make it harder hit. When VAT spreads, when supply gets nationalized, the price on the screen becomes irrelevant because there will be no metal to buy. You can't eat a photograph of a sandwich, and you can't spend a screenshot of the silver price. Even the good ones become subject to geopolitical risk. I can't hedge. Trigger 3. If the gold to silver ratio hits 40 to 1, I would consider my silver position full and shift to a hold and wait posture for the long-term collapse. That doesn't mean I'd sell. It means I'd stop adding and let the position ride through whatever comes next. Now let me address something important. A lot of people ask me, what about gold? Isn't gold the safer play? Gold absolutely has a role. Bateman allocated 39% of his physical holdings to gold for a reason. Gold is more liquid internationally. It's more compact for large wealth. It has thousands of years of monetary history, but here's my perspective. I am not betting on stability. I'm not trying to preserve wealth through a mild recession or a soft landing. I'm betting on the proven history of atomic mass over digital scops and fiat illusions. Silver has industrial demand that gold doesn't. Silver has a smaller market that creates explosive upside when capital flows shift, and silver in physical form has the same zero counterparty characteristics as gold. For me, silver is the asymmetric bet. Gold is the insurance policy. But again, and I cannot stress this enough, I don't know your situation. Maybe you need liquidity. Maybe you're in a country where silver ownership is restricted. Maybe you can't physically secure large quantities of metal. These are personal decisions beyond repair. The $300 trillion global credit bubble isn't something that can be managed with interest rate adjustments or quantitative easing. It's a mathematical certainty of collapse. And when it collapses, the only wealth that will matter is wealth that exists independent of the system. That's not gold stocks. That's not silver ETFs. That's not even crypto. Despite what the true believers will tell you, it's physical metal in your possession. Bateman's move was an exit strategy from a failing system, and here's the thing that should terrify every traditional investor. Bateman is not some doomsday prepper living in a bunker. He's a successful tech entrepreneur with access to the best financial advisors money can buy. If someone at that level is exiting the traditional system, what does that tell you? It tells you the smart money already knows. They're just not broadcasting it on CNBC. Think about the incentive structure here. If you're a major institution holding billions in paper assets, the last thing you want is for retail investors to figure out that the emperor has no clothes. You need liquidity. You need bag holders. You need people to keep buying stocks, bonds, and ETFs while you quietly rotate into hard assets. So you trot out your analysts to tell everyone that metals are overvalued and speculative and dangerous. You publish reports showing how equities always outperform over the long run. You remind people that you can't eat gold and silver doesn't pay dividends. All technically true. All completely irrelevant when the system itself is collapsing. I've been stacking silver for 12 years. I've seen every argument. I've heard every rebuttal, and I can tell you that the people who mock physical metal ownership are the same people who have never experienced a true currency crisis. They've never watched their bank account freeze. They've never seen their government confiscate retirement accounts. They've never lived through hyperinflation where yesterday's life savings won't buy tomorrow's groceries. They've only known stability, or at least the illusion of it. Bateman understood that the illusion is cracking, and he moved accordingly. Here's what most analysts are missing about the current moment. We're still in the early stages of retail awareness. Yes, silver is at $103. Yes, that's gotten some attention. But the average person still doesn't understand what's happening. They see a headline maybe about precious metals rally, and they scroll past it. They're still watching their 401k hoping for a recovery. They're still buying index funds because stocks always go up. They're still operating under the assumption that the system works. But that's changing. Every time there's a bank failure, every time there's a payment processing glitch, every time a government announces temporary capital controls, more people wake up. And when they wake up, where do they go? They go to physical assets. We're watching the early tremors of what will become a retail tsunami. Right now, you can still call a bullion dealer and order silver coins. You might pay a premium. You might have to wait a few weeks for delivery, but you can still get it. In 6 months, maybe not. In a year, I'd bet against it. Not because silver will be expensive, though it will be, but because it won't be available. The dealers will be out. The mints will be backlogged. The refineries will be running at capacity and still unable to keep up. And at that point, price becomes theoretical. What's the price of silver when you can't buy any? Whatever someone with metal is willing to accept. And in a crisis, that number might be a lot higher than you think. Bateman saw this coming. That's why he moved $1 billion in early 2025 when premiums were reasonable and supply was available. He didn't wait for confirmation. He didn't wait for the mainstream narrative to shift. He acted on the data. And here's what I'm seeing right now that confirms his thesis. Dealer inventories are already starting to thin. I track this obsessively. The major online dealers, APMEX, JM Bullion, SD Bullion, their in-stock pages are showing longer lead times than I've seen since March 2020. Some popular items like American Silver Eagles are already showing 2 to 3 week delays. That's not normal for this time of year. January is typically a slow month in the bullion business. People are recovering from holiday spending. Tax refunds haven't hit yet. This should be a period of abundant supply and competitive premiums. Instead, we're seeing premiums on physical coins running 8 to 12% over spot and climbing. That spread is telling you something important. The paper price and the physical price are starting to decouple. The paper silver market says $13. The physical market says 103 plus 12%, and good luck finding it even at that price. The Great Taking. There's a concept floating around financial circles called the Great Taking. The thesis is simple but chilling. In a systemic financial crisis, the legal structure of modern securities means that retail investors don't actually own what they think they own. Your stocks, your bonds, your ETF shares, they're held in street name by your broker. You have a beneficial interest, but the legal title belongs to the institution. And in a bankruptcy scenario, those legal distinctions matter. Creditors have first claim. Institutional counterparties have second claim. You, the retail investor, are last in line. Now, I'm not here to argue the legal minutia. Plenty of lawyers disagree on how this would play out. But here's what I know for certain. Physical silver sitting in your safe does not have a counterparty. There's no broker, no custodian, no legal chain of title that puts someone else's claim ahead of yours. It's yours. Period. In a scenario where banking assets are being seized, where retirement accounts are being restructured, where governments are imposing capital controls, that distinction matters more than anything else. Bateman's allocation wasn't based on maximizing return in a stable environment. It was based on surviving an unstable one. And survival in this context means maintaining purchasing power and liquidity when the traditional system fails. And that's why he sold his SLV shares. That's why he took physical delivery. That's why he structured his holdings the way he did. He wasn't trying to beat the S&P 500. He was trying to exit the game entirely. I want to close with a thought that's been on my mind a lot lately. There's this assumption in modern investing that you always have time. Miss the bottom? No worries. There'll be another entry point. Waiting for a pullback? Just be patient. It'll come. And in normal market cycles, that's true. How? But we're not in a normal market cycle. We're in the end game of a 7-year credit expansion that has no historical precedent. And in an end game, the rules change fast. One day you can buy silver at spot plus $3 premium. The next day, dealers are sold out, and the premium is spot plus $20. The day after that, there's no metal available at any price. That's not hyperbole. That's exactly what happened in March 2020 when COVID lockdowns hit and retail investors panicked into physical metal. Dealers were cleaned out in 72 hours, and the spot price, it barely moved because the spot price is determined by paper derivatives on the COMEX, not by actual physical supply and demand. The paper market can show $103 while physical coins are trading at $130 or not trading at all. So when I talk about the window closing, I'm not trying to create urgency for the sake of urgency. I'm pointing at the historical pattern. Bateman moved between October 2024 and March 2025. At that time, silver was still under $30 per ounce for much of that period. He's already up over 300% on portions of his position. Not because he's smarter than everyone else, though he's clearly very smart, but because he acted early. He didn't wait for certainty. He didn't wait for the mainstream media to confirm his thesis. He saw the data, understood the implications, and moved. Let me bring this home. David Bateman's $1 billion move into physical silver was not a trade. It was an exit from a failing system. It was a recognition that the $300 trillion credit bubble is not a problem that can be solved, only a collapse that can be survived. And survival in this context requires assets with zero counterparty risk. As we move forward, as retail demand continues to build, as supply chains tighten and governments start nationalizing production, the current $13 price may one day look like the buying opportunity of a lifetime, or it may look like the last exit before the bridge collapsed. I don't know which. What I do know is this. The life raft is physical. The clock is the $300 trillion bubble, and the people who understand this are already moving. If you want to understand how the banking cartel is attempting to hide the supply deficit right now, if you want to see the vault drainage data that nobody talks about, you need to watch my previous deep dives. I break down the exact mechanism they're using to suppress price, the legal loopholes that allow it, and why that mechanism is finally breaking down. But more importantly, start thinking about your own exposure, not what your financial advisor tells you, not what the talking heads on TV recommend, your own exposure. Do you own assets that will survive the system failing? Or do you own promises from institutions that might not be around to keep those promises? That's the question David Bateman asked himself in early 2025, and his billion-dollar answer is now sitting in vaults under his direct control, physical, sovereign, immune to the coming reset. The rest of us have to decide if we're going to learn from his playbook or wait for the mainstream narrative to catch up. By then, the metal will be gone and the window will be closed. This is the reality we're facing, not someday, not eventually.